Alright, good morning. So in this video, I'm going to explain the types of order we have. I know a lot of us have been using these two tools, these two types of order. We have market order and we have limit order. But I'm still going to explain just briefly in case you have forgotten so that you won't mistake it for this other two. Alright, so basically, these types of orders, you're going to see them on your Binance. Right, if you want to place your orders on futures, you can see when you click on limit, you have different types of order. We have post only, we have market, we have stop limit, stop market, trailing stop, TWAP, TWAP. But we're not going to be using all of them. We're just going to be focusing on market, limit, stop market, and stop limit. All right, so let's look at them now. Under market execution, actually, when you select market execution and you want to place your trade, immediately you type the price. Let's say Bitcoin is trading around 20k, $20,000. If Bitcoin is trading around $20,000 and you use the market order to place your order, that is where you are supposed to type the type of execution. Here you select market, right? If you have market here and you type the amount you want to use to trade, immediately you click on short or long, your order is going to be executed using the price at that moment, the price that the currency is trading at that moment. That is what is going to be used to execute your trade immediately. So, and that a lot of manipulation can happen there. So to use that option, you must be very sure of what you are doing. Maybe you have missed out on an entry and it's already going and you don't want to miss out. You can use it, but you should know the consequences. The broker or Binance can manipulate your entry because you don't have a definite entry that you used, so they can just put it anywhere. But that is just what the market type of order is all about: executing your trade at the market price at that moment. And you know, price fluctuates, so you may not know the exact market price that you selected at that moment. You press that long or short button. All right, that's market execution. So we have solved that. The second type of execution is the limit execution. Many of us are familiar with this limit execution. Now, what uh, limit execution basically is that you want the Binance to execute your trade when the price of a particular asset has gotten to a particular point. For example, let's say BNB is trading around $300, for example, 300 USDT, and you want to place a long trade. You want to long BNB when it comes down to 295, or you want to short BNB when it goes up to 320. You use the limit order. So basically, you can just come here, change this market to limit, make sure it's on limit, then you type the price you want to, either long or short. You type it here. They call it limit order. All right, so once your order is filled, it would execute your trade. You can select long or short. All right, it will execute your trade. Many of us are already familiar with this. So that's what limit order is. Now we're going to talk about the main ones that many of us don't use, and not using them, you are actually missing out on a lot of things. Now, the first one among the ones that are not popular is stock market. Now let me explain what stock market is. All right, stock market is when an asset is trading for a particular price, is fluctuating like this. Let's say these are the prices moving. It's going up, it's going down, it's going up, going down. Now what stock market does is that when you want to place a stock market order, you place it either above or below the price it is trading, and your prediction is that if the market should hit that price that you put on your stop order, it should continue that direction that it was coming from. All right, for example, This is BNB moving. This is BNB moving. BNB was trading 300, 295, 300, 295, and so on. But at the point that you placed your order, let's say BNB was 320 here, you placed a stop order here at 340. You typed 340 here. It means you are saying that when BNB hits this 340, which is the price that you selected, you want it to continue longing it. You want to long BNB at a higher price. It's different from your limit. Limit, you are saying when it comes down, all right, it should long it. Or when it goes up, you want it to short it. All right. Limit is when it goes up to your price, it should short, or when it comes down to your price, it should long. But in your stop order, when you select stop market, all right, when you select stop market, you are saying when it is coming to my price, when it hits my price, it should continue that direction that it was coming from. When it comes down to that price, it should continue shorting. All right. Now you might be asking that what kind of condition will I find myself that I would want to use this kind of order? Let me tell you something. There are times, many of us know times that there's always a spike in the market. For example, there's USD, United States dollars interest rate news, or there's a speech that maybe the Feds are trying to give, and you know that when they give that speech, immediately at that second, the market spike up or it goes down. The thing is that you can't know whether the market is going to spike up or go down, except you have some information from the hedge funds that give you that kind of, and it's not always accurate. So what do? The market is moving sideways. Most times the market will always move sideways at that point, but suddenly you just see a spike, boom. You see a spike either upwards or downward, boom. Most traders that don't know anything about this stock market, what they do is that once they know that that thing is going to happen, they leave the market and just observe. That's the safest way to avoid something like that, because if your analysis is right normally and that spike happens, it will nullify your analysis, and it can get you liquidated or hit your stop loss, and you won't like it. So in that case, you can actually take advantage of that spike, because if that spike should happen and you are in that market, you make a lot of money. If it goes your direction, you make a lot of money. So what do you do? Let's say BTC is moving up, going down, moving up, going down, moving up, going down, and it gets to a point that it's going to spike either upwards or downwards. Let's say it's moving, let's say it's going to spike, either upwards or downwards. So what do? You set a stop market order. For example, this price right now is around 23k. I can set my stop market order at 23.1 and also 22,900. Now when I set my stop order, this one is for long and this one is for short. If the market spike upwards, it will hit my entry and to continue longing it. If the market spiked downwards, it will hit my entry and to continue shorting it. All right. As I state my order slides, I'm also going to set stop loss, because it can always be, the market can also retrace. All right. So I'll set my stop loss. If I set 23.1 here, I can set my stop loss at 23.50, and here I'm going to set my stop loss to what? 22 850, so that when the market goes down, if it wants to retrace and hit my stop loss, I know that at least I'm not losing everything. All right. So that is the main purpose of stop market. I'm just using this as an example. This stop market order is not only restricted to maybe when there's a spike. There are times that you might be confused in the market and you want to be using edge mode to just know that, okay, will the market go, will it continue, will it break my resistance or go like this? Instead of doing that, you can just set a stop market, all right, in both direction. If you hit one of them, you continue riding it. If it hit the other one, you continue riding it and you delete this one. All right, that is how to take advantage of the stop market order. And lastly is the stop limit. Yeah, stop limit. See, if you understand what a stop market order is, you understand stop limit. Now, what stop limit does is that when the market is moving, you can say that if the market hit a particular point, set a limit order. All right, if it goes like this, if it hit a particular price, set a limit order for me. All right, so it's like combination of stop and limit. All right, so if it goes, let's say Bitcoin is at 23k, if it hits 23.5, set a short limit for me at 23.050, so that when it hits this one, it will come down. But if it doesn't hit this 23.5, it will not set this. Also, you can say if it comes down to 22k, set a buy limit for me at what? 21.9. So that is it. Don't get confused. Stop market is different from what stop limit. So let me show you on the chart. Now I click on this limit. You can see I have stop market. My stop markets, I can long or short. I can long or short. You can see I can switch from short to long. Now if I want to long, I'll put the price I want to long at. Like for example, look at the market at 21.508. I can see 21.550. Long, continue longing. If the price rise up to 21.550, continue longing it, and I'll set the price I want to trade at. Then I'll click on what? Long. I'll click on long. Or if I want to short, currently the market is at 21.512. I can say if the market goes down to 21.400 and I type my price, continue shorting. You can see the market is above it right now, but if it comes down to that place, just continue shorting. That is what stop market. While stop limit, all right, stop limit, as I've mentioned, stop limit, when the market comes down to what? To a particular price, set a limit order for me. Or when it goes up to a particular price, set a limit order for me. I hope you understand that. So that's it.